FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. It's the Financial Survival Network, and you are listening to Kerry Lutz. What is going on with the crazy economy? Well, you heard from Andrew Hoffman. You heard from John Rubino. Now you're going to hear from Bob Hoye, great financial historian and student of credit busts. And Bob, welcome back to the show.
Good to be with you, Kerry.
Hey, well, it's kind of been a roller coaster ride here. Volatility way up. And with volatility is always opportunity. What are we supposed to do here, Bob?
Well, we're looking at the whole financial market rather than specifically precious metals or commodities or things. We look at the whole thing. And 3 weeks ago, I had a theme in the weekly letter that was enthusiasm. Then we expected volatility, and after volatility would be the resolution of all of the great enthusiasm, and I'm talking about the stock market, and also about the low-grade market. The enthusiasm in the junk bond market has been extraordinary. So you had the technical measures on the stock market, sentiment and momentum accomplished around July. And with that, you also had the huge expansion in margin debt outstanding on the NYSE. And we found it on previous big bubble tops like 2007 and in 2000 that peak in the margin, although it was disturbing as it was flying up, it actually led the high or the important break in the markets by 3 or 4 months. So that counted out to somewhere around late September, beginning to see some nervousness coming into the stock market. Now then on the S&P itself, in the month of August, we have a model, we call it, that gives upside exhaustions. It has to do with the dynamics of the market and also the duration of the run. And that gave a monthly upside exhaustion for the month of August, and even though there was a setback in September, it gave one for September. The last time this gave that signal on the S&P was in the early part of 2000. As that bubble blew out in March of 2000, the great tech bubble and the great crash that followed that. So that one came in, and you had sentiment figures like the bears and bullish sentiment got down to 13.3% bears only. I think the last time that would have been seen, it was in 1987. So you had readings on the stock market of enthusiasms and momentum that you only see at important highs. Then we had our own proprietary model, gave the upside exhaustion. So then you wait and watch for the break. Now, accompanying this, as I mentioned, was a lot of enthusiasm for lower grade bonds. And I think as time passes, people look back over their shoulders and say, just how insane could they be? With the drive to near zero interest rates, it's forcing investors in fixed income side to do absolutely reckless things by reaching for yield in lower grade credits. And it's been, the bubble is so big you can't imagine it. It's a lot bigger. The market cap of the bond market is a lot bigger than the market cap of the stock market. And then on top of that, you got the derivatives, which is even bigger. Mm-hmm. And it's all based upon, or the extension of all this recklessness is based upon the interventionist economics. And they have this idea that if they provide credit, let's put brackets around that and say depreciate the currency, then that will drive commodities up, and that will then improve pricing power in business. And, they got this idea that if they push credit, they're going to get GDP. And, of course, what happens is that that worked in the 70s, where they were pushing credit and wages were soaring, Commodities were soaring, producer price was soaring, the CPI was soaring, and went up to 14% in 1980. So that was when it really worked, and gold, of course, gold and silver flew right on up to horrendous prices. And then all that came apart. Now, this was the trick to understanding what's been going on since, is that the Fed may be reckless, but the public chooses what it wants to speculate in. And it speculated in wages and consumer prices and commodities and gold and silver to 1980. Then the action shifted over to speculation in financial assets. And that has been the main party there. The long bear market in precious metals and in commodities was perplexing to, I think, both central bankers and the gold and silver bugs. But at any rate, you've had this also interrupted by the usual four-year business cycle thing. So what you then came up to is 2007 really was a classic bubble, quite like 1929. 2000 was an extraordinary event, isolated basically to speculation in tech stocks. There was not any boom in commodities. Real estate was quiet. And so, but in 2007, you had the real estate, you had a pretty good, let's call it a secondary market in commodities, and then that brewed up into a great bubble. And that began to come apart in May, June of 2007, going into then the great credit contraction. Now, here's where history has provided a guide, because everybody knew that the markets were distorted all to hell in 2007, and then going into 2008, you just knew in the summer that thing was going to crash in the fall. Now, here's where the gold community didn't quite get it right, because they have this theory that absolute hell is when the dollar will go to zero.
Mm-hmm.
And what the markets have shown is that if you have the whole of the world positioned for the dollar to go to zero, and the dollar goes up, that's a different kind of hell, but hell nevertheless. So anyways, that's what you faced in the fall of 2008, and it was a classic crash. We shouldn't also note that in the 1929 crash, the S&P fell 80 to 85%.
Right.
The London market, which was a senior market, then a more mature market, their stocks only went down by about 50%. So here, this time after 2007, I think the decline in the S&P was of 48%. So you didn't get the full 85, but then that was reasonable. It was much more of a mature economy and a mature financial market by 2007. So then you had the first expansion out of a very severe crash. And it was interesting to see that the economy started up virtually right away. I mean, the panic ended in March 2009, and the rebound, the economy was considered to be end of the recession in that June. So here's what we're looking at now, is that let's say that this is, I think another week we'll know whether this is a cyclical bear market for the stock market, in which case whatever good news there was in the economy through the summer will disappear pretty quickly. And we want to go back to 2007, where the stock market peaked in in that October, and the economy peaked in December. Now, typically, in a non-bubble world, the stock market peaks 10 to 12 months before the economy does. But when you're in the end of a classic bubble, the economy begins to shut down with the stock market. So now here's our thesis for right now on the economy, is that we figured that so long as the stock market was going up, there would be positive economic news, positive business reports, that sort of stuff. And the stock market rolls over, it'll take business activity with it. So let's just look at the stock market. And it is a little oversold here now. But we want to look at what happened in, about April, May, when the grains became very oversold. They got the rally out of the first of the year, and they get overbought, and then they came down and got very oversold, and there was just a weak recovery for a week or so, then boom, and then now down to new lows recently. So this is one of the old sayings about the stock market, is that major hits to the stock market occur from an oversold condition.
Mm-hmm.
So then we'll also want to look at the U.S. dollar index, the DX. which earlier in the year, say May, June, we thought if commodities rolled over and the junk bonds stopped going up in price and started going down, which they did, that then the U.S. dollar would strengthen, and we had a target of around 85. And then when we got to that 84, 85, the near-term numbers were getting overbought. But then that's where we put in the observation that, hey, the dollar index is overbought. But if you look back in the early 80s, when commodities were really coming apart, that dollar index just kept marching on up. So our advice then on the dollar was that while overbought, it could go further, which it did do, and then it became more even bought. So maybe we get a brief period, maybe into next week, of correction in the U.S. dollar. One might ask, if the U.S., the Federal Reserve is so reckless, how could the dollar possibly go up? And it's glib, but we could say that the whole of the world is short the U.S. dollar, because if you're leveraged long bonds and stocks or commodities, you owe that money. So it's an effective short position of dollars. Then the other thing is that in a great financial bubble, all you need have happen is that most of the new debt written, either for sovereign nations or for corporations, all that you need is to have most of it written in the financial center, which is New York, and due and payable in New York with U.S. dollars. That then is the other huge short position in the currency. And then the observations are made decades ago about the senior currency in the post-bubble condition is that the senior currency becomes chronically strong against most other currencies and most commodities for most of the time. So that most of the time gives us some elbow room, but what it is intended to mean is that you get the business cycle, and when you're into the positive business cycle coming out of 09, the U.S. dollar would weaken because the price of things are going up. And then when you go into a recession, which seems probable, it would be associated with a rising dollar, which is on. So that then also intertwines with lower grade bonds because we've found that over decades, as the commodities go down, so does S&P earnings. And I think the link is that with commodities going down, it represents a diminution of pricing power by many different kinds of businesses, not just commodity business, but many kinds of business. So they haven't got pricing power. It gets very competitive. The earnings are impaired. Then you get into debt coverage. And then you get the ratings agencies looking at things. So I think all of this will be probably become more visible over the next few months. And if the dollar, maybe it's somewhat more overbought than it was a while ago, but if there's another leg down in these financial markets, we should always keep in mind that all of the big bubbles since the first one in the South Sea bubble in 1720, they all, and there was 5, the 2007 one is number 6, and they all suffered heavy liquidation in the fall months, particularly concentrated near the end of October, then a relief rally and a bit of a test of the markets into November, and then that ends the first wave of selling pressure, and then, you'll just see what happens after that. And we're using that now because things became so exceptional during the summer months.
Mm-hmm. Yeah, and you think it's going to follow through like it usually does, huh?
That usually term has a bit of irony to it.
Yeah, I mean, history repeats. It doesn't repeat, but it rhymes, huh?
Yeah. We're now looking at things. Say there's a downdraft over the next couple of weeks, then we would get out our near-term stuff and watch for the overbought, and then get prepared to reverse positions. And you got to always remember that at these periods of contraction, and as you're at the boom, everybody thinks that the central bankers have got control and they're running the show and they're accommodating all speculators. And in this case, with the ECB picking up buying bonds after the Fed's bond buying program comes to an end in this month, it is easy to believe that they really have got control. And it's easy to believe that in 1929 or 1873 or going all the way back, that the government was always in, even the South Sea bubble.
Mm-hmm.
South Sea Company was a quasi-government company.
Yeah.
It was then being used to fund and pay down really offside government debt in England. So you can say with everyone, you can find evidence that the government was very much in tune and part of the party. So then how do you go against all of that forces and say, hey, it ain't going to work? Then that's when you fall back on the technical tools. So when the price rise ends and rolls over and you got all that margin outstanding, then the power shifts from the central bank to the margin clerks. And their job description is vastly different to that of a central banker. Central bankers' job description these days is to keep everybody leveraged, keep the accounts offside, and the job description of a margin clerk is to get the accounts onside. And this is where the margin clerks, when you're in precarious conditions such as we are now, they have more power than the central banker, and it's always been that. So let's look at that. This is going to culminate perhaps in the next week or so, and then we get a breath of fresh air for a while. But it's also going to affect it has affected the precious metals, because one of the signatures of a pending reversal in the credit markets is that the gold-silver ratio starts to go up. And this is evidence in that for almost 300 years.
Yeah.
So when the gold-silver ratio started to go up what was that, April, May?
Yeah, we're seeing it up now, boy. It's over 70.
It had to rise through 69 to become a warning. Then it was become volatile and going up and down was a hint that the speculation boom was getting fully done. And then when it turned up, it would say, hey, this is so. It did rise to 71, and that was associated with bids disappearing in any number of games. So it's also, if you flip it the other way, Kerry, the silver-gold ratio has been very good for us, because in an ordinary boom for gold and silver always outperforms gold, and we follow the RSI, the momentum thing on the silver-gold ratio. And in 2011, that thing got up to 92. So we look back and say, when was the last time it got to 92? Well, that was in January of 1980, which was the top of that great bubble. So we pointed out this was highly dangerous speculation. And the crash or the decline or the results wouldn't be as bad as what followed 1980. Then you had the first big rebound out to September of 2012. And on that one, the RSI got up to, I think it was 80 or 81. Mm-hmm. And that said anything over 78 is dangerous. So we pointed that out. And even this year, we, in November, looked at the pressure on most commodities and said, hey, we're due for a good rotation here. And that's what we call it, a rotation and question mark. Looking for a low in most commodities for around December. And most did fit that pattern, and they had some really terrific rallies out to, say, April, May. And then the RSI on the silver-gold ratio got up to above 80 on that one. And so we advised people taking money off the table in the precious metals. And then now what it's been doing, and we flip it the other way, the gold-silver ratio, when it rises, it gives a warning on pending credit problems when you're in a party in the credit markets, which we have been. So I think the next few weeks are, to use the Chinese expression, going to be interesting.
Well, they've been pretty interesting recently, that's for sure.
Yeah.
What's the so what are you thinking for precious metals? They've been
now
going up recently.
Now the power rally in the dollar kind of got overdone last week, and you've had a nice rebound out of gold and silver, but silver is one's not outperforming the other, so there's been a little setback to ratio, but it's not suggesting that, hey, things are really going to change and we're going to go into a typical bull market for precious metals with silver rallying faster than gold. Don't see that at all. because in every post-bubble contraction, the gold-silver ratio goes up, and we expect it to go up on this one. Remember, in the 80s, with that contraction, whereby the Hunt brothers in 1980 figured it was going to go to 16, and it did touch 16 briefly. It got out to 100 in the unwinding of all that stuff in 1990-91. And then, so let's say, if we are into a cyclical contraction in the credit markets, you could see the gold-silver ratio going up to 90 or 100 in there, depending how bad it gets. So this is where we then prioritize. And if you want to own gold, it's always a good safety item to have. Wouldn't bother with silver. And but where the opportunity will be, of course, is trade the gold stocks here. The juniors are very packed in, and there are some good ones left. And so if one wanted to own gold, we would accumulate gold on weakness. And going back a couple of months, our target to a probable time to accumulate the junior gold stocks was towards the end of October, based on all the things we've talked about so far. So we'll stay with that. I think that one should begin to be positioning in some of the juniors now and not being too aggressive and waiting for the market to really get turned, which we would know better by, say, end of November.
Right.
But here's the big thing is that if you got this opposite thing going on where we've had a cyclical bull market in orthodox investments, that means stocks, bonds, and commodities. And it's been a cyclical bear market for precious metals. And that's the way it works. So here we're now looking at the best way to look at it is gold's real price. And rather than deflate it by the CPI, we created our own commodity index because the most commodity indexes out there have gold in it. And if you're going to get the price of gold divided by commodities, you don't want to have gold on the top of and the bottom of the divisor.
Mm-hmm.
So it set what we considered a cyclical low in January, our gold divided by commodity index, in June. And then by middle of July, it had set an uptrend. But what it needed to do was break out above our number of 3.90. And it did that a couple of weeks ago. So and this is likely to continue. This is now a new bull market for gold's real price. And the importance here is that like crude oil coming down now suggests that the cost of power and blasting agents for mining is diminishing, going down, and if gold's holding its own, then so it's the real price that reflects profit margins for the industry. And it's been rising since June. But the problem is the gold stocks is you got this big boom or the big New York market to deal with. And when this liquidation phase here is finished, then the gold stocks will fly. So we expect gold stocks to be the big performers once we're past the bottom, and it could be for a couple of years. And this is also a cyclical bull market for the whole industry. And we're very positive about that. The ones that are left on the junior side will be outstanding movers.
Yeah, that's the key, the ones that are left. And on that note, Bob, just tell us your website, where we find you on the web.
Yeah, on the website, institutionaladvisors.com. And then in these days with internet magic, if you just Google my name, Bob Hoye, Hoye, it all comes up, all of the stuff. It gets you into all of our sites and that sort of stuff. And we would welcome people to look at. We offer not old issues, but a free trial subscription for 4 or 5 weeks. And if you like it, you get on board. If you don't, that's the way it goes.
Yeah, the hell with you. But so I guess in other words, we're going to know soon what's happening, and it's going to become very obvious, I guess, based on what the broader market, what the New York Exchange does, the Dow, and that's going to tell us, and the dollar too, for that matter.
Yeah,
and,
as we've been talking, that stock market went from minus to plus, and it's back to minus again.
Little schizophrenic there.
Yeah, indeed. Okay.
So, all right. And hey, just go over to financialsurvivalnetwork.com if you're having trouble finding that link, and make sure you sign up for our newsletter. Bob, we will talk with you again real soon. Thanks so much.
Very good to be with you.
FSN Radio. It's all about what's next. The Financial Survival Network. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.